The S&P 500 has just issued another very important sell signal. My name is Keith Richards. I'm going to do a very quick but very important video today, and we're going to update you on where the S&P 500 is and what the likely outcome over the coming days and weeks will be for the markets. I think you're going to enjoy this one. Let's get started. Okay, a little bit of history. I did a video called False Rally, and I asked if the rally we were seeing on the S&P 500 was a head fake or false rally. And I gave you a couple of specific targets that if the market reached and then breached to the upside, we could be back to the bull market. However, I noted on that video that if the market hit either one of those targets and fell, the probability was that we were going to be in for more pain on the markets. Now, you'll notice I use the word probability a lot, and that's because technical analysis, fundamental analysis, any type of financial analysis is a probabilities game. I've been in this business 35 years. I've had professional trading coaches through my career, and I've learned a lot. And now I coach others. And I can tell you that anyone that says that they know what's going to happen, they know that gold's going to go up, they know that Bitcoin's going to go up, they know that whatever, name your favorite thing, oil's going to go down. That's called a flat assertion. And flat assertions are for amateurs. Please don't make a habit of making flat assertions. Sometimes I see them in my comments. And I always know you're an amateur if you're making flat assertions because you don't know and neither do I. It's all about probability. It's about finding out which way the market is skewed and then going with the trade and minding your stops so that if you're wrong or if it turns out that your systematic approach is having one of those times when it's not working, you get out and don't take too much of a haircut, pardon the pun for a bald guy. So let's take a look at the signals I gave you on that Feb 24th, and then let's take a look at what's happening right now. What we're looking at here is a chart of the 200-day moving average and the 50-day moving average applied to the S&P 500. Those were my two targets for the rally. What I noted on the video and through many of my blogs, for those of you who subscribe to my blog at ValueTrend.ca, I was saying that if the market hits either one of those moving averages and fails, we have evidence, no flat assertions, we have evidence for a bear market. So what happened? Let's zoom in. And what you'll see here is the market right on schedule, the S&P, hit the 200, barely made it through, and then failed. The other thing I want you to notice is that while the market was in a downtrend, look at the size of the red candles. Red candles indicate big down days. That's when the market fell a lot. You can see the size of them. Notice that the white candles were smaller. Now look at this rally. This rally had pretty pathetic small white candles. And sure enough, as soon as the market fell again, and I'll erase a couple of these lines here, as soon as the market started falling again, big red candles, just like before, okay? So what that was telling me last week, that it was a low conviction rally, and again, if you follow my blogs at ValueTrend.ca, I talked about how low conviction the market looked in the rally, so it does not surprise me that the 200-day moving average was that point of resistance. So now it's falling. Well, what's next? Let's take a look at some history. Well, let's go way back to the 2000 bull market, the market that ended in 2000 as a bull market and then began a major bear market through 2001 and into 2002. And what you can see here is that we saw a breakdown just like this time, where the market started making, I'll zoom in a little bit, the market started making lower highs and lower lows, and it broke below its 200-day moving average. That's this red line here. look what happened. After that initial sell-off, we got a rally. Guess what? It stopped right at the 200-day moving average. And you know what happened next? Another rally right up to the 200-day after a pretty good decline, and ultimately a washout in 2002. That market saw the S&P fall 50%. So watch the 200-day, and whenever you get a rally and a failure, you have a probability, not an absolute, of a bear market beginning. Now we're going to look at the 2008 and 2009 sell-off. So again, leading into that through 2007, we saw a market of higher highs and higher lows and adherence to the 200-day moving average. But as soon as the market that time made a double top, two tops, and then started making lower highs and lower lows, we knew that we were in for a possible bear market. At that point, just as we did this year at ValueTrend, we began selling, but not too aggressively, because our other rule is that we need to see if the market will rally through the 200 and the 50. Well, here we go again. This is 2008. We saw the market decline. We saw a rally. Where did it stop? Right at the 200-day moving average. And you guys know what happened next. Pull back, and in this case, massive sell-off. Another 50+% bear market drop. Big ones. So mind the 200-day moving average. Last bear market to look at was a fairly recent bear market, and that is the bear market of 2022. Here we can see same thing that's happened fairly recently. We saw a market making higher highs, higher lows. We saw it break its 50. We saw it break its 200. Well, in this case, it rallied. But where did it stop? It stopped at the 50-day moving average. Now, if you go back to that video on February 24th, that was my second target. I said if it fails at the 200, then you got to be careful. It may rally through the 200 and go to the 50, but if that fails, another signal is given. So in this case, the market decided to fail at the 50 and on, and for those interested, the S&P 500 fell from peak to trough by the end of 2022. I think it was September, October, by 26%. I don't think we want to participate in those kind of drawdowns. So now I'm going to go back to my original chart of the S&P 500. And what I want to show you is our strategy this year. So we use a program called the Bear-o-meter, and I will be talking more about this in the upcoming video on our entire process through 2025 and how we managed to outperform the market by a significant degree, as you will find out. But I'm going to give you all the sectors and stuff we bought. This is just more of a market update. But I do want to show you that as the market started to peel back and break the 50 and the indicator that we call the Bear-o-meter, which is a meter that reads sentiment and breadth and other factors that can give us a heads up to potential action on the market, good or bad, those signals started coming through and we began to raise more and more cash. So by the time we came into the recent pullback through March, we were already at 24% cash and about 6% in T-bonds. So that's what we've done. Now that we are seeing the market break the 200 and it looks like it's failed at the 200, we are going to be raising more cash this week. Are we going all out? We never do that because anything can happen. Remember, no flat assertions allowed. But what we are saying is our system tells us a failure at the 200 that lasts more than 3 days, which this one has, means we have to raise some more cash. So far, holding roughly 30% cash between the cash and bonds has been an excellent thing for us, along with the gold, the oil, and all those other things that I like talking about in these videos. We've had a fabulous year to date. And we're going to talk about that later in the week. But I just want to bring you up to date. As I said, our strategy right now is we will do another leg out of the market and see what happens. Now, your question might be, what if you're wrong, Keith? What if the market goes back up? That's fine. We will leg back in as it goes back through the 200-day moving average, as if and when. At this point, we must assume it was a failure and we act accordingly. We're very structured at ValueTrend, and I can tell you it's better to have a structure than an opinion, because your opinion is not worth the paper is written on. So you have to work with a strategy. I outline my strategy on the online trading course. I do recommend you take it if you are interested in trading. But the bottom line is, no matter what we do and no matter what you do as an investor, as a trader, you have to be unemotional, systematic, non-biased, no flat assertions allowed, and just let the tape tell you what your next move is. Thanks for watching. We'll see you at the end of this week with a very exciting video on ValueTrend's full disclosure of our positions. I can't wait. See you then. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk, spam, and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.